This is Dave Brown. Welcome to another episode of the Tech Transfer Podcast. I'm here with Trent Mano, who is the co-founder of Convoi Ventures, located right here in Orem, Utah, and it's a pre-seed fund. So, Trent, can you tell us about Convoi and what is a pre-seed fund?
Yeah, absolutely. So Convoy, we're a pre-seed fund that focuses on Utah. Pre-seed to us means that we're the first check-in that's backing these great Utah-based founders. There's many different stages within venture capital, and our goal is to back the earliest founders as early as possible. And for us, we're typically writing, between $250K up to $500,000 checks. Into great technology companies that are, have aspirations to become $1 billion plus companies. So,
Sure. Would that be the same as kind of friends and family? Is it kind of that sort of level where some people might say, I have a rich uncle, I'm going to go talk to him, or they might come to a fund like yours?
yeah, half of the investments that we've done have been alongside kind of that friends and family, the angel investor round. And then half the time we're investing alongside kind of more traditional venture capital funds. So we're find ourselves right in that sweet spot of like to be as early as possible, and we don't really care who we're co-investing with.
Okay. And a lot of startups, we'll have our student startups or other startups we license to. A lot of people, at least initially, will feel that they want to bootstrap and keep equity for themselves, understandably. At what point do people decide, no, it's pre-seed funding is the right option for us?
Yeah, there's no one right answer to that question. I think every founder kind of goes down their own path. An extreme example is Qualtrics. Qualtrics, I think that
Yeah.
they did their startup, I think 12 or 15 years that they bootstrapped before they raised their initial round of funding, and so they went big, raising over 100 million in their first round. That's one extreme, and then some they'll say from a pre-product perspective. I'd say that's more rare. That's typically folks that have had an exit before or been very successful in their career, that are able to do that. But most folks, it's like they need some validation, need some traction. Typically, we'll have a product built. But yeah, really just kind of depends on each company.
Okay. And also some VCs that I talk to many VC funds will say, we're later, come back when you're making X million dollars a year, and then we'll fund you at a time when maybe you don't need that much money. And I think the reason some don't do pre-seed funding is because they're afraid they'll get too diluted by the time the company exits. How do you deal with that kind of risk, or how does the math work for you?
Yeah. I would say that there's multiple reasons why folks don't come in on the super early pre-seed round. Dilution's one of them, but I think even more than that, it's just really hard to tell, like if you've got a winner or not, and so I'd say that's the bigger piece of the risk. As for us, of course, we're wanting to take risk adjusted bets. So from a valuation standpoint, we're wanting, since there's significantly less revenue and in some cases no revenue at all, we're wanting to take kind of proportionate risk for the validation that exists, validation, traction, etc. So we're trying to get in at a better price, get more ownership for less dollars, but that's the trade-off in those earlier bets.
Okay, great. So let's talk a little bit about what are the factors for a pre-seed investment for you? What are you actually looking for?
Yeah, I'd say if there's 5 factors, probably the first 3 or 4 are the team. And so it's team, and then market and then the problem and the solution that they're going after. But yeah, for us, primarily as we're evaluating founders, we want to understand that they've got some unique insight or some earned secret, we call it, and so that just something where it's like, and then this unfair advantage. So that earned secret and unfair advantage, you kind of combine those two, and really we want the founders to have a strong answer to my favorite question to ask founders is, if we were to give this exact same idea to 99 other people, 99 other equally smart, equally hardworking people, why would you beat them? So there's this aspect of like, the idea is a portion of it, but the execution is more important. And then like some unique insight or some unfair advantage that you have, be that through distribution, be that through the way that you understand the customer, the way that you have networks, something that the vast majority of other founders would not have if they're going after that same thing.
That's great. Yeah, I'm fascinated by the idea of an earned secret. Yeah, I'm really interested. And one of the great things about the podcast is I can learn things that aren't written down anywhere else, right?
Yeah.
So what's an example of, and it's It could be public now, but what's an earned secret you've seen that was really compelling?
Yeah. I mean, a lot of times, I'd say the most common example of the earn secret is somebody who's like been working at a company, and they just said every single customer that I have, we do not have a solution for this. Everyone's asked us like, oh, what about this? What about this? And they're like, and I just spend years saying, no, we don't do that. No, we don't do that. And then they get to the point to where like, man, next thing I do, I know exactly what I'm going after. And so that's Jaron Paul from Spiff. He's a great example of that. They went after this problem of commission for salespeople, and he's just like, I just was cobbling solutions together. I never had anything good, and everyone that I talked to, we asked them, they're like, yeah, spreadsheets, and so it's like, being able to identify a problem and be like, yep, I know everyone else has the same problem, and I've looked for the solution because I'm desperate to find it because it takes me so much time. So having those and those are things that we see regularly, that it's somebody who's been in an industry and a problem adjacent to the one that they're solving becomes very obvious to them that there's a huge opportunity to go after.
Yeah, super insightful. That's so valuable. We've had some of our professors have had us meet with industry experts before just to learn what the problems are. Like, what should we actually be researching here?
Yeah.
And, you mentioned the importance of team. You're kind of a community builder, right? I think before Convoi was a venture firm, you were doing Convoi events for people. Is that right?
Yeah, exactly. Yeah, the way that Convoi started. So I've always built community. Always felt that relationships are one of the most important things in a career. So Convoi started as a travel series. We took founders around the country, internationally, with the goal of building relationships through experience and adventure. So we had 20 of these trips where we took people around the country, and internationally went to Whistler, Dominican Republic, Mexico City, Tokyo, Seoul, etc. All building relationships. So at 250 different founders that went on, that had this like travel community that we built of founders, and that became the kind of the genesis for like, man, this is a great way to have great deal flow, to understand everything that's happening in the community. And everyone's looking for smart, ambitious people, because being a founder is a lonely road. And so having people being able to build a community of smart, ambitious founders, has been a huge advantage to me in my career over the past 12, 15 years that I've been building community.
Yeah, and building the community in Utah has gone really well. We'll talk about that more maybe in a minute here. But when people are forming teams, like the ideal team you might invest in, is that usually that they've been to networking events, they've met some people that they'll work well with, or is this like a buddy from college that they're teaming up with? What do you see?
Yeah, my favorite thing is somebody who two or three people that worked together previously and are like, hey, I love working with these people. Whatever I'm doing next we're going to be working on this thing together. That's my very favorite thing, because they've been battle tested before. They probably were working at the same company, and at the same company they both gained that unfair advantage and that unique insight, that earned secret. So that's my favorite thing. This being a BYU podcast, a company that we backed, Lovage Labs. The four of them, they all served their mission together. They're all technical, all software engineers, and in the mission home, they all were building software for the mission. So they spent their mission working together, and so they worked very, very well. And they're like, yep, whatever we're doing next, we're doing it together. And so that's an example of just like, there's so many risks that venture capitalists take. A founder and co-founding team, whether or not that they can work well or not, whether they have the same mission, whether they're aligned, whether or not their skill sets match up. That's a super important part of the equation.
Yeah, and I have seen a few former mission companion teams launch companies around here, so that's really
absolutely, yeah.
I think on your website you mentioned that you're looking for freak founders. So when you look at an individual who could be a great founder, what are the attributes? What works best?
Yeah, I think that there's a lot of characteristics that freak founders have. To me, there's kind of two simple things that are hard to measure. But like when you encounter somebody who just operates on a different plane, you can recognize it pretty easily. The first one is energy. So there's people that you're around that you just, by being around them, you're like, man, I'm just kind of like, I feel more, I have more energy as a result. Every way they approach everything is very contagious, and they're the type of person who, you know, work is fun for them. Work is their play, and they'll just constantly work on this, constantly be thinking about it. In sports, basketball, football, they talk about people that have a high motor. You don't really teach a high motor. You're more or less born with it. And the folks that have really high energy, I've heard Ryan Smith from Qualtrics described as somebody who's like never ending energy, high motor, always going. And I think to an extent, people either have a high motor, have super high energy, or they don't. You kind of find people like that. And then the second thing that I think people have or they don't, is ambition. And I think that ambition is largely like the people who are doing lemonade stands from the time they're 8 years old. They just kind of always wanted to do that, and it might be some of the influence of their family, but they took whatever like exposure they had, and they really ran with it. The biggest difference that I see between energy and ambition is while they both kind of exist to like a natural level, energy increases linearly, meaning like the things that you do as you have wins, as you have momentum, positive things that happens, your energy increases linearly. But ambition, as you start to have wins, you start to say, oh man, the way I was thinking about this was kind of small. I think that this can be significantly larger. When it comes to venture capital, probably the biggest reason that why things aren't a fit, that successful companies that could be successful aren't a fit, is because they're going to be successful, but not like $1 billion company. They might sell for 50 million, which is life-changing money to sell a company for 50 million. That's nothing to be ashamed of, nothing to look down on. It's just not a venture scale. So if you don't have the ambition of trying to grow a massive company, I think those are big. So those two things, energy and ambition, are it just feels very different when you meet founders that have both of those things in outlier levels.
Yeah, that makes a lot of sense. In terms of the size of the opportunity, for something to be investable, how big should it be?
Yeah, rule of thumb is $1 billion company. We look at is 100x opportunities. In order to return the fund, it needs to be at least be able to scale to 100x what we invested in at the valuation. So if we're investing in a $10 million valuation, we wanted it to be $1 billion outcome. If we invest at a $5 million valuation, we wanted it to be at least a $500 million outcome. But still, pretty much everything we're seeing, this can be a $1 billion plus company.
Yeah. Okay. Well, great. Well, I know you've worked on a couple non-monetary issues too, like more like qualitative things. You had a mental health startup, I believe. And then you've also talked about types of founders that we should see more of in Utah. What needs to change here, and how do we do it?
Yeah. I think that there's in Utah, we get very very comfortable with pattern matching, and I think that is especially in Utah, is like, if you look at the majority of the tech CEOs, I'm a Mormon male, but and there's nothing wrong with backing Mormon males, but I think that it's like there are a ton of people who are from the same background, and that's something that we're always looking for, is like, what are the common backgrounds? And if you go past that, it's a very sales driven sort of a founder. So things that we're looking for is people that come from different backgrounds. Might be gender, might be race, might be coming from a different country, might be different education. I personally, one thing that I've noticed and been thinking a lot about is Utah versus Silicon Valley. We have significantly more sales and go to market driven CEOs than we do than exists in the Bay Area. And kind of to the second part of your question, I don't know that anything needs to change necessarily there. But like as we're looking at opportunities, I think that have backing technical CEOs, folks that have a technical background versus more of a sales and marketing background. I think that's where we'll start to get more ambitious technical projects and things that are going after much bigger swings. I look at Taurus as an example, and the founders there, they're technologists, and the thing that they're going after in the renewable energy space is it's a massive opportunity that they're going after.
And what is their product? I'm not sure I know.
Yeah. So it's basically in the renewable energy space. They're doing a battery that is able to capture the energy for residential and commercial buildings and make it much more reliable, so that as they have are connecting to solar, et cetera, that they're able to kind of control their own energy sources. So it's a big opportunity, and it's a massive opportunity. And and we're not talking about a billion opportunity. We're talking about a 10 or $100 billion size of company that they're trying to go after. And I think that takes some more ambition when it comes to kind of the technological risk that we're trying to take in the state.
Okay, great. Well, in terms of sales-driven companies versus technical-driven ones, completely right. Like we have so many sales-driven companies around here, but tech transfer technologies are hopefully launching more tech-based companies. So I hope that trend continues.
Yep.
In terms of back to the topic of community building a little bit, I believe I heard from someone, and maybe it was the governor, I'm not sure, that by 2030, Utah Valley will be more populous than Salt Lake Valley. That's the projection. And so huge growth down here. What have you seen, and what's happening in Utah Valley in terms of connecting entrepreneurs with each other?
Yeah, absolutely. The largest effort that we're making is something called Utah Tech Week. Utah Tech Week is a grassroots festival for the startup community here. It's a free to host, free to attend. Anyone in the state, or even people coming out from outside the state, could host any event that they want. And so it's really just taking down the barriers. You go to a lot of conferences that'll be $500, $1,000, $5,000 for this. This is free. Anyone can attend. So really just trying to make it much more accessible. The first year
and I should say that that happened last year and it was great. And so I said, okay, next year we're doing it. So this year we'll try to put something together, because there are many virtual events as part of it, right?
Not a ton of virtual events.
Are they not?
So there are some, definitely, but I think the real magic of it, as you think about the community building, is that face to face. Having that connection. I think that's where real, it starts from a connection on LinkedIn that turns into a Zoom call, that turns into a lunch meeting, that turns into a kind of deeper relationship or partnership. So yeah, we think that the in-person aspect of things is very important. And that's where partnerships are made. That's where, people buy each other's services. That's where people learn from each other. So yeah, Utah Tech Week, there's 197 events that were put on by members of the community, startups, venture capital firms, universities, government orgs, nonprofits, and 15,000 people attended across all the different events. So yeah, great. It was a great event. And yeah, we're extremely excited about year 3 that's coming up in January and February of this year.
Okay, well, we didn't do the first couple, but we'll do one this time. It'll be great.
Yes,
definitely. So good. Well, so you're dealing with so many founders. A lot of people want to launch new ventures and they don't know how to do it. It's really intimidating, a lot to think about. So what are some tips for first founders? What mistakes do you see people making that they could avoid?
Yeah. I think one of the biggest mistakes that founders make is they get too focused on raising capital. And they let me say it this way. There's two ways to raise capital, multiple ways to raise capital, but I think kind of two ways in startup land that people really think about. One is raising capital from investors, and then one is raising capital from customers. We always say if you can raise money from customers, do that. That's the better way to go, and seek the validation from your customers, not from investors. In the tech transfer space, those might be more capital intensive projects, but there's other ways in terms of grants and things that might be better sources of capital. But as much as possible, go to customers. The customer's voice and customers' feedback matters more than anything else, and even more than their voice and feedback is what are they willing to spend money on. That's the true story to tell. And when we're diligencing a startup, when we're trying to decide if we're going to invest in a startup or not, one of our first things that we'll do is say, hey, here's a couple potential customers. We want to see if people on our network want to buy what you're selling. And so that's more than focus groups, more than surveys, more than anything is will people buy what you're trying to build? That's, I'd say, focus. If there's nothing else no other advice that a founder was to take away, it's like sell the thing as much as you can and that's where you get real feedback, is if you're building something of value or not.
Yeah, well, in terms of tech transfer, that makes a lot of sense to me. Some of our technologies, though, are either maybe early for the market or they're a new market. So we have one, for example, there was video online, so you might have seen it, that's a 3D hologram, essentially free floating in the air, like volumetric display in the air. So that's awesome, but there's no market for it because no one's ever had anything like that. But if you have something that's really revolutionary, what's a good way to approach it?
Yeah, I think finding folks that are, um, there's a lot of different appetites for venture capitalists. There's some that all they want to take is execution risk, and what I mean by that is the technology is pretty straightforward whether or not it can be built or not. And so there's a lot of venture capitalists are moving towards like B2B SaaS, like this. That's the thing. I shouldn't say moving. Have already gone to where that's the focus. And so understanding that, the thing that I tell founders a bunch is there's so many parallels between dating and venture capital and startups, that, it's like, what do venture capitalists look like, or look for? And I'm like, I don't know. When you're dating, what does the opposite gender look for? And it's like, well, everyone's different. What do you mean? Like, and it's like, yeah, exactly. Every venture capitalist has different thesis, different things that they're looking for. So when you're building some revolutionary technology, there's firms that will say like, hey, we only back cutting edge technology. We only back deep tech things. We only back things that are started by people with PhDs, et cetera. And so just really understanding that you are, by introducing technology risk in addition to the execution risk to it, you're adding another layer of risk. And so you need to find folks that are willing to take that level of risk on as well.
Absolutely. Yeah. Okay, super interesting. So so you have a fund, and you started in 2021, I believe. Mm-hmm. What made you decide to start a fund, and how did you go about it?
Yeah, absolutely. So, I've been in and around the startup space for the past 15 years. And so starting agencies, nonprofits, venture-backed startups, Series B stage startups. So I've been in and around the space, and always, considers myself, a startup and a venture capitalist junkie, reading everything that I can, and meeting everyone that I could in the space. It accidentally kind of started our firm, and what I mean by that is it was never like, oh, one day I'm going to start. I just never really thought that it was on the radar. But my partner Scott Paul and I, we decided that we were gonna he'd been an angel investor, he'd done 70 investments of his own, and he was just like, hey, I'm putting a ton of my money, my own personal money. We should probably start a fund around that. So put our heads together, and we said, let's start a fund, and had a great network of high net worth folks, mostly founders and operators, almost all founders and operators, people who've had exits, people who wanted to support the next generation of Utah founders, and decided to raise a fund to do that. So yeah, that was a few years ago that we started working on that, and 41 investments later, we're just starting to invest out of our next fund here. So yeah, so we're off to the races and doing some good things in the state, we feel like.
Okay, yeah, definitely. So I know we're running short on time, but what have you enjoyed most about it?
Oh, working with founders, like, but by far the best thing that to take a very, very basic analogy, when you're if you ever gone yard sailing and you find kind of this diamond in the rough, and you're like, oh, this is what I've been looking for. It's kind of the same thing. We meet with over 100 startups a month, and we back one of those every month. So 1% ish that we're backing. So it's extremely rare that we find something that we're like, okay, this is something that we want to back. But the rush that you get when you know that you found something that you're really excited and can be a game changing technology, it's hard to match that feeling of backing of an ambitious founder that's going after something that can really, really change the industry that they're in.
Yeah, I got to say, working around startup companies and entrepreneurs has made me look at people a little bit differently. I'm totally looking for that person as well, right?
Yeah, absolutely.
So you've interacted with so many people in the space. What's the best advice you've received from an investor or entrepreneur?
Best advice that I received. Ooh, that's a hard one to my favorite advice that I like to give to people is don't take anyone's advice. The reason why I say that is because like the when we back a founder, they're typically the experts in their space. They're going they spend way more time thinking about the problem, talking to customers, talking to experts in the space. And if a venture capitalist or if somebody a supposed expert in the space says, "Oh, I don't know about that." If you have enough customers that are telling you otherwise, like trust your instincts. I think really, again, I said this earlier, like really go after that customer validation and understand that like you'll hear a lot of conflicting advice and if take it all as data points, and if the data points are all lining up in the same direction, then that probably is something that you should follow. But if you're getting lots of different data and lots of different advice, then follow your gut, follow your instincts, and follow the the customer validation that you're seeking after.
Okay. Well, fantastic advice. Well, thanks for coming on today, Trent, and sharing your wisdom with us and knowledge of the space. If people want to connect with you or with Convoi, what should they do?
Yeah, absolutely. If you're a startup that's looking to pitch Convoi, it's Convoi, CONVOI, convoiventures.com. And you can just go there. We do only back Utah-based startups. So if you're not based in Utah, unfortunately, you're not a fit for us. And then you can find me really easily on LinkedIn. Trent, Trent, Mano, Mano. And I'm the co-founder and GP of Convoi Ventures. So you should be able to find me really easily in those two spots.
Well, great. It was great talking to you, Trent. Thanks so much.
Yeah. Thanks so much, Dave.
Take care.